Ever wonder how financial advisors really make their money? There's fees, there's AUMs, there's commission. It can get a little confusing to say the least, but it's one of the things that you really want to know because you got to figure out if the advisor's working for you or they're working for a company or they're working for themselves. Let's break it down plain and simple. I'm Drake Riggs, founder of Obsidian Wisdom. I specialize in helping folks retire without running out of money, dealing with crazy healthcare costs, or feeling stuck in retirement. Today, we discuss the question that everybody wants to ask, but nobody wants to talk about, and that's how financial advisors really get paid. Let's go through the three most common ways financial advisors get paid. We'll go through the pros and the cons, and then I'll end by sharing with you how Obsidian Wisdom, how we get paid for working with us. The first pricing model that we'll discuss is commission-based pricing. This is probably going to be one that you see when you work with an insurance agent. It might be one that you see when you visit your bank. When you go to your bank, if you have a personal banker or there's a financial planner there, 9 times out of 10, you don't actually pay them anything out of your pocket. They are giving you a certain list of products. You choose those products and they get paid based on the products that you choose. That is often the same situation with most insurance companies. You go to the insurance agent, it's very unlikely that you're going to physically hand them money unless you're trying to bind that insurance contract. So that way, if something happens to you while you're waiting on getting the underwriter's approval, you still count as having insurance. Outside of that, as far as paying for the services, you rarely will pay something out of pocket. In each of those situations, it feels like you're not paying very much up front. They seem relatively cheap, if you're just being honest. Nothing comes out of my pocket. I don't really feel any of the stress of paying a bill. The reality is the fee is built into the products that you choose. And that sometimes can lead to what we would call a conflict of interest. And the conflict of interest is basically saying, depending on what they offer you, that is how much they get paid by a commission. And so there are some situations where maybe they'll say, hey, we're selling annuities this month. And if you have 10 annuities, we'll pay for you to go to the Bahamas. Now, it's not saying that the advisor is going to offer you the annuity because they're trying to go to the Bahamas. It is just simply saying that if you are working with someone that is commission based, that is what the companies generally do. They give incentives. They're already commission based, so they already have an incentive based plan. And so they just have extra perks for some of the products over other ones. There are some, and I remember when I had first started, I worked at a firm and it was commission based, and they would have it set up where basically you would say, well, you can get maybe 50% of an insurance premium, or you may only get like 0.001% if you just put their money in inside of like a mutual fund or something like that. And so you can see that the way your pay would work is you basically couldn't even pay your bills if you just put everyone under some sort of a mutual fund. And then you probably could be living La Vida Loca if you put everyone under like a whole life or some insurance product. Now, the questions become ultimately, does that mean that a commission based advisor is less trustworthy? And I would say no, it doesn't inherently mean that. The reality is you can find a honest and ethical advisor in every single one of these pricing structures. But the reality is there is a conflict of interest when you're commission based because your relationship is with the insurance company. Your relationship is not with the agent. And ultimately what we're saying is because the insurance company designs the products that are being offered by the agent, the insurance company inherently has designed the game in their favor. That I would liken it to if you went to a casino and there was a dealer that was handing out cards. They're not actually doing anything wrong. They shuffle the cards, they hand the cards out, they shuffle the cards, they hand the cards out. But because the casino designed the game, we're well aware that if you play any game of the casino, it is slightly in favor of the house, which is a very fancy way of saying that if you were to play slots and slots was like 55% probability that the casino is going to win, every time you play, no matter how often you win, you're going to ultimately lose money the longer you play because it's designed in favor of the house, right? The house always wins. If you were to go play poker and sit at the table, and that one I think is maybe like 51%, 52% tilted towards the house, all we're saying is the longer that you play, eventually you run out of money because if I lose 51% of the time, I still lose the majority of the time. And all we're saying is the insurance agent is like the dealer. The dealer at the casino is just giving out the cards. They're not doing anything wrong. They're not changing the game in any way. But because they're dealing out the cards, it's already a conflict of interest because they're giving you cards to a game that the casino has already designed in their best interest. A lot of the times, these insurance products are designed in the interest of the insurance company. That is why when you look at the top 100 successful companies, you're going to find several insurance companies right there at the top because they understand how to design the game. They have actuaries, they have mathematicians, they have all sorts of fancy people coming up with numbers to almost exactly predict the likelihood of us winning versus them winning. And then they build their products based off of the tilt in their own favor. Right. So that's all we're saying with commission based products. And so that's why it's something to think about. The next one is going to be your AUM or your assets under management. And what we're saying is basically you get charged a fee based on the assets that you have under management. That fee is on average 1%. So all we're saying is if someone has $100,000, then 1% of that is $1,000. If someone has $1,000,000, 1% of that is $10,000. And that is what your annual fee will be. On the positive end of that, it aligns your goals with the firms that generally speaking, as they make more, you make more. And so you grow together. So they are interested in your success because that's the only way that they're going to make more money. You also are baking into the cake that we're going to have a long-term relationship. That realistically speaking, once I'm holding your funds and I'm allocating the trades and we're doing all this and that the likelihood of us staying together, as long as I don't do anything crazy, is higher. That is very likely that if someone is managing your assets, that they are continuing to grow the investments, that at least we have a long-term relationship. And depending on the services offered by that firm, it's very likely that you're going to have your planning fees already covered inside of what that AUM is. And then I've seen some where the taxes are covered inside of it. And then I've seen some where it's not. I've seen some where the investment management is the only thing that's covered. And I've seen some where they have other services that are covered as well. You really have to take that one almost on a case by case basis. Now, as far as the cons of the asset under management, the largest one is, well, if I have more money, I get charged more. And depending on the services and the complexity of my situation, maybe not. I might feel like I'm being overcharged a little bit because if we just stick with the idea of the 1%, we're basically saying, all right, well, I understand that someone with $1,000,000 might have a more complex situation than someone with $100,000. But do I feel equally as confident that someone with $20 million, that their situation is twice as complex as someone with $10 million? Because the person with $10 million is going to pay, right, 1% is $100,000 a year. And someone with $20 million is going to pay 1%, that'll be $200,000 a year. Do I feel that that captures the complexity of the situation? Because there is a point in time that I think we would probably say, I don't really know if there's that much more services being offered. And then we'll all differ on where that number is. You might say it's $10 million. You might say it's $1 million. Some of you might say it's $100 million. But the idea is at some point, I'm just paying more in fees, but you're not actually able to offer me much more in services. That sort of leads into the idea that we're getting paid a lot of times based off of the investment strategy. But what about my investments outside of the stock market, right? If I have businesses, if I have real estate, are you able to capture that inside of my fee? Maybe I don't have a lot of assets under management, but everything's inside of my business, and I still need the wisdom to be shared with me so I can make good decisions on how I manage my company. And you'll find many times that sometimes can sour the relationship in some ways because the advice that I want doesn't really require me to put the money in the stock market. But the only way that you could get paid is by having money in the stock market. And sometimes the way it can feel is almost like we have a gym membership and we're paying the same amount every single month. They have the card on file so they don't call us, they don't ask us about it. But we're not 100% sure what we're receiving in value. That it just at some point we're just like, I don't really know if I need that membership because I don't go to the gym that often, or the machines are always not working, or they're always being taken. Whatever the situation is, you're just kind of like, I almost feel like I've outgrown it for my own personal situation. And that leads us into our third and final pricing model, which is going to be a flat fee only advisor. So if your financial advisor is charging you a flat fee, this flat fee could be based off of their hourly rate. It could be a retainer that you pay every single month, or you could pay it annually. It depends on how you want to set up the relationship. Now, this also will be the one that probably feels the most expensive because this is the one that you're paying out of your pocket versus if you go to a bank and you talk to the advisor there, You don't actually pay anything out of your pocket. Now, we do know that they get paid and we know that they get paid a commission, but we don't feel that pain right away. It would be the same as if we go to a gas station and you and I get gas. We recognize the price of gas a little bit better because we know we're filling up our tank and we're looking at that fee because it's right on our face. Versus if it was like our Netflix subscription that is tied to a credit card and we don't even really see it. We just know that it works when I turn it on and I don't really have to pay anything actively. And so you just feel a little bit more. And so that's why this one can feel like the most expensive one. Now, this one is product neutral. So because you're going to pay an hourly rate, it's almost like having an attorney. You will just be charged whatever the time is. So if you want the time to be allocated towards your real estate or your own personal business or your investments, we just pay for whatever the time ends up being. That also gives you the ability to have a little bit more of a comprehensive plan where because it's product neutral, we can kind of talk about anything. You're paying for the advice, you're paying for the wisdom. And because you're paying for the advice, we can talk about anything. You don't have to be steered towards any product. The advisor is not limited to the products that are offered by that particular bank or that particular insurance company. That doesn't really matter. That the advice can be based off of what your needs and your unique situation are. That's why a lot of people end up liking that. Now, some people just like paying the advisor directly because in their mind, someone is paying this person. And if I'm the one paying you, I feel like you're going to be a little bit more loyal to me. That ultimately the fear is that whoever is paying the person is who the person is loyal to. Now, just like all situations, as we mentioned many times, it's not inherently true. There are advisors that, even with you paying them, are going to look out for themselves first and foremost. That yes, they don't have to look out for the bank or the insurance company. No, they don't have to make sure you have assets under management, but maybe they're overcharging their hourly rate, or maybe they still get kickbacks. Almost kind of like the kind that you hear about with some investment advisors, where the mutual funds that they recommend, they get some sort of incentive to recommend those mutual funds. It's the same that you see in a lot of different industries, and that's probably a different conversation for a different day. But even there are some doctors where the pharmaceutical industry, where if they recommend those products, they get something back. That there is that just underlying feeling where you're just like, I just don't know who you're working for. But as far as the opportunity to be able to have someone that's looking out for you, it's increased when you have someone that's neutral to the product, that they just kind of get paid no matter what they recommend. Hopefully, it's just good recommendations. And they don't have the inherent conflict of interest of only being able to offer products that are designed by that bank or insurance company. So the AUM model is sort of like having a Netflix card on file and then you just pay it every month and you don't really think about it. Or it could be like a gym membership where it's just on file and you don't really think about it. Whether you go or you don't go, you just pay it every single month. A fee-only model would be more like I paid the personal trainer to give me a training plan, and then I have the choice of taking that plan and doing it on my own, or I have the option of working with this trainer ongoing, and then I can work for 3, 6, 8 months, however long I want that relationship to last. That is how fee-based pricing model is. So over my financial career, I have been a part of all three pricing models. And then I have found for me, the way that I envision my financial firm being a flat fee pricing model works the best for me. And there are two main reasons that we went that route here at Obsidian Wisdom. Number one is I always, in my mind, envision this being an education first firm. And when you have commission based products, the regulators are a little bit more strict on how they review your educational content. Because as we mentioned with the casino, where the dealer is not doing anything wrong, but just by giving a card to you, the dealer is helping the casino win, right? Like that's just because the casino designed the game. So if you're offering commission-based products, even if you're saying everything right on the up and up, it doesn't change the fact that you're giving products that are tilted in the advantage of that financial firm. And so because of that, it inherently means every time you speak, it is in your firm's best interest and is at the disadvantage of the person. And that was definitely something that I found frustrating, because I'm just trying to educate people because there's so much nonsense out there on the internet. And then two, I was really questioning. I was like, okay, if that's how the regulators feel about me, is that true? Like, should I find a different way to be paid? And so that was when I ultimately started looking, and I found the Series 65, which is the RIA, and then you're able to charge a fee directly to the person. which now establishes us with a one-on-one relationship. Because before that, you pay the fee to the insurance company, and the insurance company will pay a commission to the agent. So your relationship is actually with the insurance company. When you have a Series 65 and you charge the flat fee, your relationship is with me as an individual. Just like if I had another advisor in my firm, they would be the same idea. Your relationship would be directly with them. And then if they went off and opened their own firm, then you could go with them because that is your one-on-one relationship. And that's how I believe financial planning should be. Like that's just my personal opinion. And the second reason I knew that the commission-based structure wasn't for me is because as I was growing and expanding my wisdom, I was able to come up with solutions that I was not able to offer based on the book of products that I was given. And then I was like, oh my gosh, if I have an idea that is better than the products I have, I am unable to offer them. I was a captive agent, I believe is what they were called. They may have renamed them by now. And it's just as it sounds. I am captive. I can only offer the products that are with the firm that I represent. And I was like, okay, well, based off of those two things, I was like, this is not for me. And so then when I founded Obsidian Wisdom and I was able to start my own firm and set our own pricing, at first I was thinking AUM because that's what almost all advisors charge. And it is kind of nice because you do get paid as the client makes money. So we've aligned our values, which was something that was important to me. But along the way, I'm just someone, right? So for me personally, I like the idea of having a set amount and then I just pay that every single month. And it's that set amount. I don't really have to think about it. It's a service and I get the service that I asked for. If I want to step up and have more services, I can. If I want to step down and have less services, I can. Right. You can think of that with Disney Plus and Netflix and my cell phone plan and literally everything where I basically say, how do I want this options to look? And I like the idea of not having to keep track of the little things. Where it's like, well, how much money is in my investments? Am I moving up to the next tier? Am I being charged a different fee and all this other stuff? I just like the idea of knowing what the set amount is, right? I was that person back in the day when cell phones used to be by the minute where you'd have to keep track of your minutes. That would drive me crazy. I was not good at keeping track of my minutes. The moment that someone put a cell phone plan out there that was a flat monthly fee, I was like, dude, this is what cell phones should be. I shouldn't have to count my minutes. I shouldn't have local versus long distance. I should just be able to talk on the phone. I don't want to have to wait till 7 o'clock for my nights on weekends. Like I just want to talk on the phone. Right. I'm probably dating myself because there's a handful of people that are like, I have no idea what you're talking about. But if you remember when cell phone first came out, there were so many ways that would trip you up. And then you would get the bill each month and it would just be much more than what you thought it would be. And so just based on me personally and everything else, I was like, yeah, I think I like the idea of a flat option because it incentivizes us in many ways where it's a better deal for you as you grow your funds, where the growth is yours. You get to keep that. And then that's going to help you out in retirement where it becomes a smaller percentage as you grow your money. And that could be your business, that could be in real estate, that could be in the stock market. As you have a more complex situation and you need more advice, you have the ability to move up a tier. As you retire and sell your business and sell your real estate, you can move down a tier as your life becomes a little bit simpler. I think that that makes the most sense from my perspective. And so that's why Obsidian Wisdom is a fee only firm where you pay your one-time fee, we build the plan for you, we spend 30 days refining and making sure you understand every nook and cranny so you feel really good about implementing it. Or at that point, you can say, Dre, I would like to have an ongoing relationship, and you can. Some people like to do a plan and walk away, while others like to walk step by step throughout the entire process together. The good news is at Obsidian Wisdom, we can do both. And we've been working so hard at growing in our ability to provide value that I 100% believe without question that the value far exceeds the prices. Not only on the returns on the investments, because, right, that's just kind of, it is what it is, but in many ways, the actual advice that is being given, the actual questions that are being answered, the confidence, the peace of mind that is being given, that feeling of knowing that you're moving into retirement with more wisdom and less worry. Some people like to do a plan and walk away, while others like to walk step by step throughout the entire process together. The good news is at Obsidian Wisdom, we can do both. At the end of the day, no matter what pricing model you go with, it's important to make sure that your advisor is clear, honest, and focused on helping you achieve your goals. Ideally, they're a fiduciary, which just means that they're held to a higher standard, where they don't have to just be compliant, they have to be ethical. If you want to learn more about how we can work together or get started with your own wealth of retirement system, let's talk. I'll put a link in the show notes where you can schedule some time on my calendar. As always, I'm Joy Griggs, founder of Obsidian Wisdom. I'm thankful for our time together. You could have been anywhere, but you chose to be here with me, and I don't take it for granted. As always, stay safe and enjoy life.